The following program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth and has a proven track record of managing long-term investments, surpassing the markets in the long term. The information shared in the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
And it is Saturday, and we are talking about money here on The Answer. The Answer about money. So today I want to talk about some serious stuff and some fun things, both worth talking about. One very serious. It started with a CNN story that ran last year. I copied the story. I've been thinking about this story for a number of months, and I thought it was time to really talk about it. The story begins, or the article begins with a story about a phone call that started the whole thing. It was a shocking phone call. It went to the nephew by the name of Jeff Reagan. The phone call was about his 94-year-old aunt. 94 years old, she was being evicted from assisted living. 94 years old, evicted from assisted living. And the next day, he received a legal notice talking about the eviction, or stating that she was going to be evicted. That situation is beginning to happen a lot these days. Evictions now top the list of assisted living grievances. Of all the assisted living problems, now eviction stacks up as number one. In 2016, the latest we have information for, there were 2,867 grievances. And that probably is a big undercount, because not everyone who's evicted files a grievance. Not everyone who is evicted has the ability to file a grievance. Not everyone who's evicted knows they could file a grievance. Not that it makes a lot of difference. It's been growing exponentially. And the reason is that we're living longer. You know, when my father was 61 years old, planning for his retirement, he was going to retire at 62. He never made it to 62. He died before he got to 62. But at 61, he was planning his retirement. And in 1978, when he passed away, in 1978, one of the options he had from his company, and it had a company had a company retirement plan, a pretty good one. But one of the options was a 5-year annuity, because most people, once they retired, would die within 5 years. That was the 1970s. It wasn't that long ago. Today, we're living much longer. Today, people are talking at 65 or 62 or 70 about a second career. I mean, think about that, the changes that have taken place. But life expectancy has been increasing, and so you find people that are running out of money. And the second thing that's happened is medical costs have been exploding. Barron's did an article in which they said a 65-year-old couple, now this is an article that goes back to February of 2017, so it's probably even more so today, but a 65-year-old healthy couple will spend, by the time they're 89 years old, should the two of them live to that point, and the odds are that they will, at least they're better than 50-50 chance they will. During that time, they will spend $860,000 for medical care. And they both may still be living and facing even more. That's where we are. Life expectancy for affluent Americans is in the mid-90s now, living to mid-90s. That means half of affluent Americans are going to live past the mid-90s. The cost could be well over $2 million, a good portion of that. So as I was doing research for this program, and I do I would be on and off and thinking about it over the last few months. As I was doing that, I Googled assisted living evictions. And what I found out was almost as shocking as finding there were evictions. I found out when you Google, you have a number of websites that will tell you how to evict a resident, a number of websites that will give you a template for the letters you write to commence the eviction, and a number of websites to tell you about the legal steps you have to take if you want to evict a resident. Think about that. There's at least 2 or 3 pages of Google ads or Google entries on how to evict a resident out of assisted living, just like the 94-year-old aunt. You know, and all of that got me to thinking about a client that I once had. The client opened an account with me. He was a postman. He had a post office pension, but over and above that, he put away a total of $216,000. This is 1987. $216,000 was quite a bit of money that way. He'd never married, had no children. He had $216,000, and he took that amount and he split it between myself and another. In those days, we were called stockbrokers, of course. That's before we became financial advisors. But he split it between myself and another guy and let us guide him on investments, do his investments, guide him through this whole process. And I used to remember talking to him during the early years, trying to get him to move the account from the other broker to me. And I'm sure that the other broker was talking to him about moving his account that he had with me to him. So as a few years rolled by the mid-90s, he one day called me and said, now the account is $1 million. That $108,000 had grown to $1 million. He said, I want to come buy you lunch. I'd never met him before that time. I started my business by cold calling. So I'd never met him. He came, we had lunch. He said he wanted to buy lunch. He drove up from Tacoma to do that. And during the conversation, he said, I should probably move that other account to you. I thought about it. I said, so client of mine, how much is that account worth? And he said, well, we did a financial plan and we did all the planning and it's now $140,000. So the account with me was $1 million, had just topped $1 million. The account under a solid financial plan, because it was at a firm that was really pushing financial plans at that time, had grown to $140,000. So my first reaction, what I said to him first off, which was kind of a flippant answer, I said, you should probably keep that account with the other guy just so you appreciate what I do. He didn't do that. He moved the account to me. So he had a couple, 1.2, 1.3 million. And the story has a happy and a sad ending. The sad ending is he lived around where you had a number of homeless people. And the homeless people would come around begging for money, and he would do things like give a guy $20 to cut his lawn. And there was one time when a guy came and wanted money, and Frank said to him, the last time I gave you $20, you were going to cut my lawn. You didn't cut my lawn. The guy said, I want $20. He said, you didn't cut the lawn. So this young guy, this homeless guy, started beating my client up, kicked him in the head a number of times, caused extreme brain damage. My client ends up in a high skilled nursing facility with brain damage. That was a very sad thing. The guy who did it ended up with 3 years in prison. My client ended up with permanent brain damage. The good part of the story, and I can't say that it's a happy part of the story, but the good part of the story is my client had enough money that he could afford to pay for that facility for the remainder of his life. He wasn't into an assisted living where he got kicked out. He wasn't into a place where he existed on the state. He wasn't into a place where His funds were used up after a few years, and he was living on state aid. He had enough money to be in that kind of a facility. And it reminded me of what happens when you have solid performance and when you have poor performance in financial accounts. We never think about something like that happening. It's like fire insurance. You buy fire insurance for your house. You hope you're never, ever going to use it. But if you do, it's a very small premium to pay for what you're going to do and what you're going to face. You hope you're going to waste that money and never have to use it. The same thing, I believe, is true of building an account. You hope that you're never going to need all that money, that it's going to go to your children or to relatives or even donate it to charities. But if you don't have enough money, will you be like the 94-year-old aunt who gets kicked out of assisted living? It's a real issue for me. It's a real issue for what I want with my clients.
Makes sense.
It is something that is, I believe, one of the major concerns for most people in this country. They do not want to run out of money. We're coming to a commercial break. Don't go away. I have a guest we'll be getting to. Great interview coming up. And I want to touch a little more on this whole story about financial planning and what went wrong. Why one account was $1 million and one was $140,000. Don't go away. We'll be back right after the commercial break.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So you've probably seen him on CNBC. His name's Josh Brown. He wrote a book called Backstreet Wall Street. He talked about what goes on with stockbrokers, financial advisors, but stockbrokers. And one of the quotes that I loved out of the book, because it's very true, says that most of the brokers I know and have met over the years are phenomenal, world-class salespeople. But a great many of these security selling savants don't attain the knowledge necessary to actually accomplish anything for their clients. Selling one's expertise is much easier than actually developing an expertise, especially as it pertains to investing. That comes from Backstreet Wall Street. There is a slogan that I faced when I worked for the big brokerage firms. It happened. It was a mantra that the big brokerage firms pushed very hard. It was sell the relationship, not the performance. Get clients to really like you. Get clients to really love you. But tell them, you can't expect performance. Even the regulator stuff plays into that. Past performance is no guarantee of future performance. And to some extent that's true, especially over the short term. But when the crash of 1987 happened, stockbrokers were the lowest rated profession. They rated below used car salesmen. No one wanted to become a stockbroker. I mean, the cartoons, the jokes about stockbrokers were horrible. So what do you do when you have a profession that rates lower than a used car salesman? You change the name. So instead of stockbrokers, we became financial advisors, financial consultants. And even now, the Securities and Exchange Commission is beginning to deal with that because they're saying, you're not really financial advisors. You're really salespeople. Anyway, I focus on performance. That's my shtick. That's what I do. That's my value that I add above everything else. We do great on service. We do great on equivalent pricing, but it's performance that counts. And this story that I told about my client shared his $216,000, split it between another broker, another financial advisor, and gave each of us half. My half ended up at $1 million. His ended up at $140,000. He worked for a firm that at that time was really pushing hard and requiring their stockbrokers, financial advisors to do financial plans. And what they did were financial plans. And I've done a number of programs saying that financial plans, traditional financial planning, has 6 defects, 6 problems, 6 really big issues. The first issue is trying to forecast if a client has enough money to meet their financial goals. And they do what's called a Monte Carlo simulation, and it's wonderful. And when I first got into the business, I thought we were going to do financial planning. I bought the very best financial planning software you could buy. You just plugged in the numbers and you ran this software. I've produced the first plan. It was 400 pages long. It was beautiful. It had all sorts of bar graphs and pie charts and all sorts of explanations. And it was glorious. I took it home to read through it before I met with a client. And I sat there in total disbelief and shock and felt terrible. That's the only plan that he ever did. It's the most expensive plan that's probably ever been produced. I also had sent my sales assistant at that time $3,800, I think, to have her spend a week learning. So that $3,800 plus her pay, all to learn that. I mean, it was the most expensive plan ever, I bet. But it was wrong. It had all these great things like Monte Carlo simulation. Sounds so wonderful, but it's based on a normal curve. And I'm a mathematician, and I'm thinking the stock market doesn't work with a normal curve. It'd be nice if it did. Normal curves, that's the bell-shaped curve. It's part of the Cauchy distribution of curves. It looks really nice. It's really easy to work with. But it's like the person who's stopped because he's lost his keys and he's under the street light looking for his keys, and a cop comes along and says, "What's going on?" He says, "I lost my keys." He says, starts looking around with him. He says, "Are you sure you lost them here?" "No, I lost them in the alley." And the cop says, "Why are you looking here?" He says, "Because the lighting's better here." So it is with that bell-shaped curve. It's wonderful to work with, but it doesn't really apply. The second issue is it's looking backward. It's using data, and it depends upon where you start your data as to the result you're going to end up with. There are periods of time when the stock market over a 20 period of time produced a 14% return, another time it produced 8% return. Where do you begin? Makes a huge difference in the result you're going to get. There's an old phrase, garbage in, garbage out, That's financial planning. It's garbage in, garbage out. The third issue is confusing short-term risk with long-term rewards. The market goes up and down, bonds go up and down. Those things happen. The other mantra that was sold in the brokerage firms is don't lose clients' money. I related that story of the financial advisor with growing that account to $140,000, while I grew his account to $1 million. He did not have a losing year. Did not have one losing year. But the account grew 40% while mine grew tenfold. The idea is clients won't move if you don't lose money for them. Over the short term, the markets go up and down. And if you're not willing to accept the ups and downs, you can't expect much reward. You can't expect that you're going to make it. The fourth is the execution of the plan. It's a plan with a market is dynamic market. Everything would work just fine if everything was static and stable, and companies always produced exactly the same amount and grew exactly the same amount. If the stock of a company went up 1/4 point every day, or even 1/2 point a week, I'd take 1/2 point a week. If that always happened and it never went down, that'd be fine. But it doesn't. The execution of the plan is crucial. And the fifth thing is there's 2 sayings about diversification. One is don't put all your eggs in one basket. And the other one comes, I think, from Mark Twain, says, put all your eggs in one basket and watch the basket. I think both are true. The less a person knows about what they're investing in, the more they should put a diversification in. If you don't know what you're doing, you should have 300 different stocks. But studies have shown, over the last 20 years, studies have shown that concentrated portfolios with a few stocks actually outperform. I've been doing that since 1991, before I knew any studies existed. And there was one from 1978. But more studies since the dot-com crash have shown concentrated portfolios outperform. And finally, they are not dynamic. They're based on past information. Past information for my father meant you can expect to die within 5 years. That's why we give you a 5-year annuity. If you base your financial plan on that, you run out of money. If you base your plan on running out of money when you're 90, you can be evicted from one of those assisted living places. That's an issue. Financial planning has real issues and it doesn't work. A lot of people found that out in 2008, 2009. I believe we're going to come to another time period when we're going to find that out again. I believe what really counts is having superior performance, and that's what makes the difference. Having the $1 million account, not the $140,000 account. Anyway, that wraps up my thoughts on that. I just had that article, had that to do. I want you to hear my interview today because it's a very interesting story, and we're going to talk about some fun things in the second part of the program. That's not quite so heavy. Anyway, my guest today is Kevin Gemeroy, if I said that right.
Gemeroy, close.
Gemeroy,
Yep.
of Dynamic Computing.
Correct.
Welcome to the program, Kevin.
Thanks for having me, Mike.
So why don't we start with your background?
You bet. Just a quick introduction. So I'm Kevin Gemeroy. I'm the president and CEO of Dynamic Computing. We're a managed IT services company based in downtown Seattle. And I think the reason that you originally reached out is I was part of the Puget Sound Business Journal's 40 Under 40 this past year. So appreciate the invitation and excited to share with you today.
So tell us about your background.
You bet. So I'm one of these very rare born, raised, and always lived in Seattle types. I know there's only maybe 5 of us. I think you and I were 2 of them.
No, I wasn't. I've been here for 30-some years, but...
Well, that's
anyway.
As good as I am. But, so yeah, I was a Seattle kid born and raised, went to the University of Washington. I'm actually a 4th generation small business owner and entrepreneur in Seattle. And I've got a good story about that I'll share with you here in a minute.
Yeah.
Started my company when I was in business school at the University of Washington. On a bit of a whim, to be honest. It was just an opportunity that I thought was worth pursuing, and I hoped that I wouldn't fall flat on my face, and I figured if I did, it would have been worth what I learned from it. And it turned into a great success, and so I'm here with you today.
And we're going to hear about that right after the commercial break, so don't go away. It's a very interesting story, and a 4th generation, not in the same company, but different companies. So you got to hear about this story. We're going to come back right after this commercial break. Don't go away. And also, the Money Show is coming to Seattle. We'll talk about that a little bit too. Don't go away. We'll be right back.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
I'm here with Kevin Gemeroy, if I said that right. A lot
did.
of times I mispronounce names, so you know.
Second try.
Dynamic Computing.
Yeah.
So we just started talking about background. Let's get into your background, including the fact that you're 4th generation entrepreneur,
Yeah.
not in the same company, but in different companies.
Absolutely. So it's a good story. There's probably not too many of these in Seattle, but my great grandfather was actually a school teacher. Grew up in Canada, and he moved to Seattle after World War II in pursuit of the dream, whatever the dream was at that time. And so he started a company that ran word puzzle contests of all things. And it's something that's kind of funny in the modern times, because you would never think of a word puzzle contest company, but he would run ads in magazines and newspapers and all sorts of different places. And these word puzzle contests would be, they would promise a $10,000 prize for the grand winner. Well, he would obviously use the entry fee that was, I don't know, $5 or $10 or something along those lines, to pay out the $10,000 prize, but he might have, a couple $100,000 worth of entry fees. And so it was a very, very profitable little business. And so he would be hired by primarily institutional nonprofits to raise funds for big capital building projects. And so there's a laundry list of great kind of monuments that have been built courtesy of these word puzzle contests. Mm-hmm. So kind of a fun story. And then, I think that we just have maybe a culture in our family of the dad kicking the son in the behind and saying it's time to go do something on your own. And so my grandfather decided to do just that. And in 1959, he started an auto paint distribution company. And so that company sold auto paint and auto body supplies to auto repair facilities. And of course, by the late 1950s, everybody was getting a family vehicle, or sometimes two even, if they could swing it. And so he, out of his basement, he would mix the paint and he would deliver it to the auto repair facilities. And at one point, he hurt himself. I think he broke his leg, and my grandmother was then doing the deliveries. And my father and uncle grew up in that business, and actually grew it up to about 6 stores, and just recently sold it. And as a kid, I would sweep the floors and break down the boxes. And then when I was about 14 or so, my dad told me, "Kid, you got to go do your own thing." And so I actually, when I was 17 years old, got my business license to be able to do freelance computer technician work. And that was my, solution. My first job was as a database entry person for a company that did home automation. They paid me $5.25 an hour, which was big money when you were 16 years old in 1997. And I decided that, that maybe wasn't the right thing for me. And so I found someone who I knew a lot about computers, and I spent most of my days fixing computers while doing the database entry. So I ended up working for another company that would bill me out at $75 an hour and pay me $10 an hour, which was now much bigger money than the $5.25. And so I think I decided by about the second or third one of those that I would rather just build myself out at the $75 an hour. And I got my business license, and that's how I paid my way through the University of Washington.
And so you started your company even when you were a student.
Yeah, so I was
So let's talk about the company.
You bet.
Dynamic Computing.
Dynamic Computing. So we are a managed IT services company. And what that means is that small to mid-sized businesses that typically don't have internal IT departments or IT teams hire us to serve that function for them. So we work primarily with companies from anywhere from, say, 20 to a few hundred employees. And we provide full IT services, whether that be help desk, IT management, communications, security, backups, and all of those other boring things that make the world go round, but most importantly, help the business continue to run. Mm-hmm. And so as time has gone, obviously the technology has evolved. We've grown as a company, and we had the great pleasure last year of being honored by the Puget Sound Business Journal with the 40 Under 40 Awards.
So let's talk about, in terms of setting up, like you become the IT department for individual companies.
Exactly.
It's something they're paying you for, so there must be a return on investment if they're doing that. So take us through the process.
You bet. So, the big challenge that most small companies face is that they can't afford to build a fully functional IT department out. You really need minimum 3 to 4 employees. One person's usually not going to cut it and be able to do everything well. It's kind of like hiring a handyman to build a house. They don't have all the different skill sets to be able to do it effectively. Well, those three to four IT people to build a fully functioning department in Seattle, that's maybe $300,000 or $400,000 a year minimum. And if you're running a company with 50 employees, that's a big hefty bill. So the benefit is really that they have the opportunity to work with an IT team of 15 of us for a subscription fee. And so what that means is they pay us a fixed monthly fee to manage, maintain, support, and do all things to keep their IT systems up and running. So the first step is really what we call our foundational IT assessment. It's kind of a consulting engagement between us and the prospective client to really understand the business, the revenue model, what's working, what's not, and then most importantly, talk to their employees. I think in business today, the number one problem that almost every business owner, manager, CEO faces is not having enough qualified people to do the work that needs to be done. And interestingly, when you talk to the employees and you ask them about the technology and what's working and what's not, they usually say that they could get about 25% more done in a day if they had the best IT systems, software, and support available. I think if you talk to any CEO or CFO or small business owner and you ask them if they'd like a 25% reduction of their payroll, they'd raise their hand and jump up and down and say, yes, absolutely. And technology can do that. And that's really what we want to help them do.
That's called productivity. That's the name of the game.
Exactly.
For labor.
It's called performance, as you said earlier.
Performance. It allows you to sell more. It allows you to cover a greater area. It allows you to service better. So in your process, you mentioned that you go in and you do an initial setup. Mm-hmm. And I assume that there's an initial fee for that. There
is, yeah. It kind of varies, obviously, just based on the size of the company, but it's anywhere from a couple $1,000 for a real small company. They could exceed $20,000 for a real large company. But the deliverable is full visibility into what the IT systems look like, what the employees have to say about the technology. It involves an executive interview, a goal-setting session, and most importantly, a roadmap. Oftentimes we find that companies are evaluating hiring, an internal person or two internal people versus us. And so it really gives them an ability that even if they don't go with us, they have a kind of a to-do list. And one of the challenges that small companies face is the CEO or the CFO doesn't really know how to manage IT guys. It's not an easy thing to do. We're a unique breed, and we're not that easy to get along with sometimes.
And also, it seems like you're up to date on the latest programs and the latest things that are coming out. I know I have to spend a couple days a year to update myself on technology in my field. And, we're just set up in a very scalable way. So that's time that's allocated. But if I had 20 employees or 30 employees, knowing what was going on in the IT department or in the market would be very difficult.
Absolutely. And more than that, your company or organization only knows what you guys know. We have the great pleasure of working with about 100 different small businesses, which means we get to see best practices, what's working, what's not, the ups and the downs, the successes and the failures across all sorts of different types of companies. And so instead of, you having to learn from your own mistakes, you have the great benefit of learning from a lot of other people's mistakes.
Well, and I can say, normally Sarah is with us during these programs, and Sarah is fixing email. Because for whatever reason, I downloaded a program today, an update, and it shut down my email. So,
and it's actually a good kind of use case for why managed IT services can be really helpful. In many cases, the internal staff of a company really struggle to keep up to date, and chances are that Sarah's time is better used doing things that don't involve fixing your email.
Oh yeah, because she's wonderful. She's absolutely awesome,
yeah. But
it's not her expertise. So tell us, if someone wanted to get a hold of you, how would they do that?
Well, first step would just be to reach out. We've got a great website, www.dyncomputing.com.
Say that again.
www.dyncomputing.com. Or give us a call, 206-284-6200 is our main line.
Say that again more slowly.
You bet. 206-284-6200.
It's great. Okay. It's a great story. It's a great business. Many times the guests on this program are dealing with the large companies, the Microsofts, the Boeings. You're dealing with companies that are 20 to 100, 200 people. That's a real service for a lot of the people that are listening to this program. And it's well worth spending the time and the effort to find out if their productivity could be increased and they could use dynamic computing as their IT department. So if it applies, please log into their website or give them a call. We're coming up to another commercial break, so don't go away. We've got a lot to cover, a lot of fun stuff, and some interesting stuff as well. So don't go away. We'll be back right after this commercial break. And you can find these programs on YouTube and also on podcast on our website. So if you missed part of it, check it out. I'll be right back after the commercial break.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So here we are, and I'm going to talk about the Money Show. I do this almost every week, and I'll continue to do it every week until June. I've been asked to do a workshop. I'm doing not one, I'm doing 3 workshops, and from the exhibition hall as well. So what is the Money Show? It's coming to Seattle. It's leading economists, market strategists, top performing portfolio managers. They're names that you recognize. Steve Forbes, Forbes magazine. Ralph Akambora, who was a technical strategist doing technical trading. Bruce Johnstone, the president of Fidelity. Larry Kudlow, who was the chairman of the President's Economic Council of Advisors. Edward Yardeni, who I think is one of the best economists in the country. Louis Navalier, who sees the world differently than I do, but he has a very large following. And of course, I'm on the program. I'm way down at the bottom, but, at least I'm on the program. And I have more presentations than anyone else. That's the fire and the logic. I'll be presenting twice. I'll be talking about the no-fee, profit-sharing, individual accounts on there's no cost, there's no fee. It's strictly, I share the profits with you. If I do well, I get paid. If you lose money, I don't get paid anything. So there's an incentive to do that. And there's an incentive to do that not in an aggressive way, because most accounts that are run too aggressively lose money. So it's more of a moderate aggressive approach. But the idea is that it is profit sharing. And this is something that's fairly new. It's a long short kind of account. It's only been allowed for the last couple of years. And in August of last year, the regulations changed, so it requires a minimum of $1 million. That's due to the regulators. If it wasn't for the regulators, I'd do a lot less. But the regulators require $1 million account size with $2.1 million in net worth. I think it's a wonderful way to go. The Money Show itself is free. Oh, and by the way, you probably heard, if you've been listening to my program, my third topic will be, or my topic of my third workshop will be, how does this secular bull market end? That's coming up. 2 workshops on the first, 1 on the third, and I don't know what I'm going to say when I do my exhibition hall thing. So I still have to I have to hear one of those. I was in Orlando and gave the 2 presentations in Orlando. I'm coming up in Las Vegas to do 2 presentations. I will check the exhibition hall. But for you, all you have to do is go and register. It's free. They expect to have about 2,000 people. In Orlando, they had about 4,000, 5,000 people. In Las Vegas, they expect to have that many. So it's a big honor for me. And so I hope that a lot of people who listen to the radio come to see the program. KLFE is going to be a sponsor, and they'll have a booth. I am also being a sponsor of the thing because that's the reason it's free, is because they get people to sponsor it. I will have a booth right next to KLFE. And actually, we had our signs made by the same people. So, I mean, sitting here in the radio station, you can't see it, but I can. It's a big sign that has a big picture of me with AM 1590 on the top and About Money on the bottom. Mine has a little bit different design because it actually has a chart of how I performed. So now you know all about it. So, shifting gears. Do you know what the world's most popular meat is? The world's most popular meat? It's chicken. It's chicken. When I was in college, when I was an undergraduate, there was a big storm that came through, and trees were falling down, things were going bad. It was a really bad storm. And on the radio, as we were listening to the radio, a public service announcement, there was a chicken farmer who said that it had destroyed a lot of the cages for the chickens, and he needed help gathering up the chickens. So there were 6 of us. We piled into a car. We had these great visions of chasing chickens all around fields and gathering up chickens and bringing them back and putting them in cages. You know, young, dumb, and naive we were. We arrived expecting to see a field filled with chickens getting ready to run and chase down chickens. It's not what at all we saw. The cages actually were like 30 inches by 30 inches by 18 inches high. They sat on stilts with a wire mesh underneath, so the chickens would poop right there in the cage, and the poop dropped down onto the ground. And what we found was the cages that had been destroyed meant that the stilts had been drawn out, and the cages had dropped down into the chicken poop, and the chickens were drowning in their own poop. That's what we found. The cages had tumbled into chicken poop, and what they really wanted was for us to help lift those cages out of the poop and save the chickens. That's what we did. I can remember the clothes that I had. I washed them 6 times trying to get the smell out of the clothes, and eventually threw the clothes away. The smell was so bad. You know, in some ways, it reminded me of Upton Sinclair's The Jungle, if you ever read The Jungle in school, you know, the meat packing industry. But today, it's an insight because chicken has become the rich world's meat of preference. You know, I talk often about technology, but we don't talk very much about technology, and it's even showing up in farming. Even though chickens are still raised in that same way, you're seeing a change in what's happened. Since 1990, pork and beef consumption is essentially unchanged in almost 30 years, unchanged. But chicken consumption is up 70%. The total number of chickens raised today outnumbers all other birds in the world combined. That's the number of chickens that are in the world today. And the price per pound of chicken is $1.92 on the average, down from $3.61 in 1960. The price is about half of what it was in 1960. You know, beef prices have been falling. They're at $5.80, down from $7.51. But in it all goes back to a competition in the 1940s when there was a competition for the chicken of tomorrow. In 1957, the average weight of chickens, 56 days old, was 2 pounds. By 1978, it's 4 pounds, and today, it's almost 10 pounds for the average chicken. Used to be in 1957, they ate less than 3 pounds of grain per bird. Today, 5.5 pounds. You know, what we're seeing is chicken is becoming the world's meat of preference, but each one of those chickens is getting bigger and bigger. And now we're seeing some free-range chickens raised, but most are still raised on those cages, in stilts, where if they have a storm, those cages will drop right down into the chicken poop. I remember that so well. That's the last thing I intend to do. Anyway, watch for chicken prices to increase in places like California, where they're beginning to outlaw that kind of raising of chickens. Will Washington do that? I think we'll start to see more and more states begin to look at how chickens are raised. But in the meantime, it's the world's meat of preference. And now you know. That's the rest of the story, as Paul Harvey used to say. I'll be back next Saturday with more information, and maybe we'll talk some more fun things then too. Have a great week, rest of the weekend, and I will be back on Saturday.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you'd like Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams, here on AM 1590. The Answer. The preceding program was sponsored by Adams Financial.